This is Greg Gallagher with G3 Investors, and this is the final report for 2017. Okay, let's take a look at the market in 2017. There were numerous records set by the market in 2017. Number one, the market was up 12 straight months without a loss. That's a record. There was extreme low volatility. The average closing price of the VIX index, also known as the Fear Index, was 11.1. That's a record since its inception in 1986. There was a flood of liquidity pumped into the financial markets by the central banks all over the world. Europe, 5 trillion. Japan, 5 trillion. China, who knows? Russia, who knows? The US, we didn't really take anything out. We didn't put any in. So the market had lots of financial liquidity. So what happened? So the bears, number 4 here, they finally capitulated. The Ridex bull-bear ratio at 0.041 is the lowest on record. Another record, 9 consecutive up years in 2017. That marks this bull market as a tie to the 1990s bull market for the most consecutive up years since 1945. And then there was the never-ending talk from the talking heads on TV, that's CNBC and Fox Business News and all of them, that small investors have missed this bull market, like they don't have a 401k, and that there is still a lot more money on the sidelines. That's nothing further than the truth. It's all BS. So here's the caution. When records are being set almost daily, this is a sign that we are nearing the end of the bullish cycle. Certainly not the beginning. But I'm not predicting a bear market. I never predict a market. I'm not predicting it in 2008 or 2019. I have no idea when it's going to happen. For example, in 1996, Fed Chairman Alan Greenspan, the chairman of the Federal Reserve, the central bank of the United States, he complained of irrational exuberance in the stock market. But the next bear market did not start until April 2000. That's also known as the 2000 to 2000 bear market, or the dot-com crash, whichever you prefer. During this bear market, the NASDAQ corrected over 80%. So what's my point? Well, most people don't understand drawdown and recovery, so let me give you a little lesson in that. In order for an investor to recover from an 80% drawdown loss, that buy and hold investor would need to gain 400% just to get back to break even. If you don't believe me, look at the math. The loss is 80%. You divide that by 1 minus the percentage of loss, which is 20% or 0.2, and you get a 400% gain that's needed. This is the number one reason to become an investor, a G3 investor. By learning to trend trade ETFs, you avoid this type of drawdown. And that's why you need to sign up at g3investors.com now. Most of it is free. If you want the pluses, it costs you $120 a year. Now that's a good meal at a good restaurant like Ruth Chris or the Capital Club or wherever. To prove my point, I'm going to take a look at the 3 major corrections in my lifetime using my system to backtest it. I'll be doing this on 3 separate videos. But just so you understand, the first market crash happened on Black Monday, October 19th, 1987. The Dow Jones dropped by 22% on that day. Do you remember where you were? I'm guessing that most of you weren't even born yet. Well, they didn't have ETFs back then, and trend trading wasn't even a dream. Okay, so I didn't do so well in that crash, but we'll go into it. The second was what I call the dot-com crash. That happened on April 2000 to October 2002, when the NASDAQ Composite Index lost 80% of its value. And I know of one investor that had $1 million in his IRA account, and I ran into him over time, and the last I talked to him, he had $200,000 left. So that could be devastating to any buy and hold investor. The last one that I experienced in my lifetime was the 2000 and 2008 financial crisis, also known as the subprime meltdown. And this guy, the Fed chairman, Ben Bernanke, he was a genius, you know? He missed this thing. He didn't even see it. So what happened? Well, the S&P 500 dropped from 1,576.09 to be exact. That was an all-time high on October 31st, 2007 to 734.52 on 2009. That's a drop of 842 points almost, or 53.4% in 16 months. But people are like, but the market can't correct, right? Now, I hate back testing because one could easily fudge the results, but since my method is easy as 1, 2, 3, it's impossible to cheat. So when you see these videos, you'll be able to count the bars, okay, and you'll see exactly what would happen. Finally, I thought this would never end, we'll take a look at the signs that an everywhere bubble, that's my term, is forming again. As always, here's the disclosures for trading ETFs. It's an educational website, good trading. All right, so much for that report. Let's take a look at the comparison for the year of the G3 trading model results to the buy and hold results. Started with 200,000, ended up with 67,803, 33.9, 58,000 of that was realized gains. The buy and hold results, 200,563, they ended up at 58,057 for 28.95. So our trading system worked better than the buy and hold system by 4.9% or 9,746 bucks. In the stats category, we had 129 completed trades. That's a little over 10 trades a month. We had 100 winning trades, 29 losing trades. That's a winning trade percentage of 77.5%. I like to bat at 700 on the winning trade percentage. We had big winners, 20. That's winners greater than 10%, $30,000, and 51% of our gain in terms of dollar terms. The small losers were 29, more small losers, but only $3,394.40. So the system certainly performed well. I've added a new quote here. We know Mr. Buffett's rule, but this one is, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. That's by Ben Graham. I think Buffett studied up on him before he became one of the greatest investors and traders of all time. These are how we do the open positions. I've explained this before. If you haven't seen it, you can go to my website and take a look, and you'll find a video on exactly, what this setup is. But it's basically, in trading, you have to document what you're doing. Okay, so I document the potential setups that I see. Okay, and this is as of December 29th. And then when the trades happen, I go ahead and document what the stop loss set was and so on and so forth. I like to say, trade what you see, not what you believe or you hear on CNBC. Now, the trading model at the end of the year was 100% invested, so we had 6 trades that we could not enter into. We're still revising our G3 Investors website. It's going to come out sometime in January 2018. This is the second day of January, and unfortunately, I'm still under the weather. I apologize for that, but I will get the website out as soon as I possibly can. Okay, the details, again, there's the 24 open positions we have. We're 98.8% invested, or what I consider fully invested. There's our realized gains and unrealized gains and loss, and there's our gains and losses, and there's all the stats. I just want to spend a minute on the last week, the week ending December 29th. And you can see from the previous, this over here, I input the daily stuff here in this yellow box, and then that was the previous close. So the last day of the month, we had quite the correction, really, for this market. It's like a major drawdown. I mean, it's just horrible. People were like screaming. No, that's true. That's not true. But anyway, for the week, we had some losers here. Then it looks like the Nasdaq's taking a hit and all that. Um, but for the December, all the indexes were positive except for the Russell, which was down slightly. For the year, it's just a blowout. Whether this is the Trump rally or this is really due to great profit and loss statements from all these companies out here, which I don't believe for a minute, but that's another story. But anyway, all the indexes made new all-time highs in December. That's why they're highlighted in dark green. And there's the year-to-date all-time high as of that time period. I want to look at one other thing really quick. I apologize for this being a long one, but this is the FinViz website. It's a financial visualizations website. Here it is right up here in the corner. I'm just moving that so I can show it to you. But this is what I like. This is one of the things. They have multitudes of things, anything you want to know about. But this is a company. But this is the S&P 500, which is the 500 largest companies in the United States. And it's the one-year performance. So you can come here and you can look at all this green on the screen. That green means 30%. There's 31% for that one. That's Google. Facebook. All right, so Facebook, Amazon, and Apple, and Netflix, I don't even know where it's at. Microsoft has also included that, and Google. Those are called the Fang Stocks. Those were basically what rocked the investment world in 2017. If you really drill down to the details. I mean, Amazon was up 52%. It's trading near its all-time high of 11,082. I mean, that's just, it's unheard of. Of course, there was Walmart and J.P. Morgan and some others that did really well. And the big loser was GE. That Immelt guy, they finally got rid of him. And then the oil and gas, I have some long-term investments in these, and I'm just sick. That's why I usually trade 1/3 short-term, 1/3 long-term, and 1/3 in other. 1, 2, 3. There's that number again. But boy, my long-term positions in energy and oil and gas equipment services took some hits in there. Again, anyway, that's it. Now, another thing this website does, and I'm going to like, it lets us look at, oh, wait, this is all red. What was I talking, wasn't I talking about, markets getting nearing a trend? Okay, this is what becomes ridiculous to me. This is the actual trailing 12-month PE for all the stocks we just looked at in the S&P 500. How much green do you see on the screen now? Well, there's Gilead, okay, and they apparently have real revenue problems because comparison problems. I think it's a great company, and I think Amazon's a great company. Google, Facebook, Microsoft, Apple, these are all great companies, but at 35 times earnings, that means you get your money back in 35 years. Here's Amazon, 295 years. Oh, that's a good one. Let's put our money in that. That's why I hate stocks. I just can't see, you can invest in an index and get all these companies in it. There's the technology index. It's just crazy to put your money in an individual company because when people wake up and decide that, hey, somebody else can go into business, Walmart or somebody can compete with Amazon, or is it really worth 295 times earnings? I don't think so, but that's just me. Now, something the market looks at more recently is the forward PE. This makes more sense because this is like, hey, this is what I'm going to earn in the future. Well, we've still got a lot of red on the screen and very little light green, which, is the really good stuff. Well, no, the dark green, sorry, got the wrong color there. Here's Amazon, 145. That's the forward PE. Yeah, I'd say that one's pretty richly valued. There's PEG ratios, and they've got price to sales. I like price to sales because that's something that really can't be fudged. You can play around. I was an accountant for the CFO for 28 years. I can tell you I can play with the numbers in a year or so, but you can't play with them. You can't play with revenues. There's nobody, no auditing firm in the world, and I was with Arthur Andersen, so you just can't get away with it there. But anyway, that's a brief look at FinViz. It's a great free website. I don't talk about it often enough. I probably should do it more. Anyway, that's Greg Gallagher with G3. I'm Greg Gallagher with G3 Investors, and I'm saying that's the final report for 2017. Good luck, good trading, and best wishes for a prosperous new year.